sleeper stocks. That's right, sleeper positions in their portfolio. And these particular positions are very, very boring, if you will, companies that throw off a lot of cash, and they do it consistently. In fact, the Oracle of Omaha, Warren Buffett, has made his fortunes, listen to me closely, on many businesses that will lull you to sleep. Now, these boring stocks are beautiful indeed. Now, there's nothing wrong with boring stocks. There's nothing wrong with sleeper stocks. In fact, there's a lot right with boring sleeper stocks. While more tantalizing names may get the media coverage and investors' attention, a number of steady Eddie stocks that pay consistently and that have consistent appreciation and oftentimes substantial income, and they have this for years, if not decades, while staying under the radar, those are positions you want to consider for possible inclusion into your portfolio. In fact, Warren Buffett, likely the world's most well-known and successful investor, has made billions of dollars on what many individuals and investors would consider, quote, boring, end quote, stocks. For instance, look at a list of Berkshire Hathaway's holdings. There's Geico and other insurance names. There's a t-shirt company, Fruit of the Loom. There's Dairy Queen, and then See's Candies. There's a chemical company called Lubrisol, and railroad companies, one of which is Burlington Northern Santa Fe. Now, these companies don't scream growth. Really, they don't scream much of anything, but it's hard to argue with the Oracle of Omaha's performance and his profits from these companies. Now, investors looking to replicate Warren Buffett's impressive long-term performance can start by looking at boring sleeper stocks of their own. Listen to me closely and take copious notes now. Now, in that spirit, yours truly would like to present to you at this point in time 10 particular positions. I'm going to give you double digits, 10 particular stocks to consider for possible inclusion into your portfolio upon completion of the appropriate drill down that might not be the next Tesla, but sure have plenty of upside and will get you P.A.I.D. Let us go to work. First, Unum Group. It's Unum, spelled U-N-U-M, U-N-U-M Group. Trades under the symbol U-N-M. Once again, trades under the symbol U-N-M. Now, disability insurance provider UNM has been around since 1848 and should be around for at least another century. And I bet you 99.9% of the people in the sound of my voice has never heard of this company, but the uber wealthy has. Now, the Affordable Care Act, aka Obamacare, has impacted U.S. operations, and the Brexit has hurt the dollar-denominated profits from a smaller UK and the smaller UK-oriented business. Yet UNM has continued to grow profits and book value, with adjusted EPS rising 8% and adjusted book value climbing 9% in 2016. A nice first quarter beat, plus an increased dividend and share appreciation, or a share repurchase plan that they're putting into effect, means 2017 is off to a good start as well. Now, despite that performance, UNM stock still looks very reasonably valued. A rough 10% pullback from early March high levels leaves UNM at about 11 times 2017 EPS estimates, and at just a 10% premium to book value. Now, with the companies guiding for mid-single-digit growth this year, a solid market position, and a roughly 2% dividend yield, the valuation looks simply too low at the moment. Now, UNM stock isn't likely to double in a year, but above market performance seems awfully likely given the current valuation. Indeed, UNM has already been one of the most consistent stocks to actualize or buy to open for some time, beating the S&P 500 over the past 1, 3, 5, and 10-year periods, and it should continue to do so going forward. I repeat, beating the S&P 500 over the past 1, 3, 5, and 10-year periods. Family members, Unum, symbol UMN, they get you P.A.I.D. consistently. Next position I want to give you, talking about sleeper stocks, is Tech Data Corp, symbol TECD. That's Tech Data Corp, symbol TECD. Now, Tech Data Corp is about as far away from a classic high growth, high valuation tech play as you can get. The company distributes IT products worldwide, a tough but uncovered business. Now, operating margins are razor thin, just 1.29% on a non-GAAP basis in the company's fiscal 2017 budget, which their fiscal year ends in January. But Tech Data has a multi-decade history of success in this particular space and benefits from a major deal that's on the way. You see, in March, the company closed on a $2.6 billion purchase of Avnet, and as a result of that, they purchased the technology solutions division of Avnet. Now, the deal boosts Tech Data's scale and gives it a stronger presence in both Asia and in data center products, two key areas of growth for tech going forward. Now, the acquisition also will have a substantial impact on TECD's earnings, with the company guiding for $100 million in cost savings by year 2, as much as $2 per share after tax. Tech Data has a clear path to a $10 plus EPS. Yet the stock trades at just $95 plus or minus, implying a potential single-digit multiple to fiscal year 2019 earnings, with incremental benefits from the acquisition likely over the long term. Now, TECD, okay, is a particular position that investors who look beyond tech's best-known names could find an unappreciated winner in TECD. Next position I want to give you is AVX Corporation, symbol AVX. That's AVX Corporation, symbol AVX. Now, AVX is a major part of the connected world, but few investors know about AVX. You see, the company manufactures electronic components, including capacitors, which are used in end markets ranging from automotive to defense to personal computers. Now, it's a relatively tough business indeed, with many smaller manufacturers around the world, along with primary rival Chemic Corporation. Results tend to be cyclical, and AVX earnings increased in fiscal year 2017, which, by the way, ended in March of this year, but declined in each of the past 2 years. And as in the semiconductor industry, price tends to decline over time. That pressure has impacted long-term performance as well. And all of AVX's shareholders' returns have come through dividends, as the stock actually has declined almost 8% over the past decade. But there is no reason to see potential upside waning for this seemingly boring stock. This particular company is going to continue to throw off that dividend and continue to get its holders P.A.I.D. Next company I want to give you is Kyocera Corp. Kyocera Corp, spelled Kyocera, trades under the symbol KYO. Now, KYO owns 72% of AVX, which I gave you earlier. Okay? And KYO's made a decision to bring sales of its products in-house. And this could foretell a change in its ownership of the company. Now, AVX itself continues to target an acquisition of its own. Okay, continues. However, more than $6 in cash per share is mostly held overseas. Talking about KYO. On a relative basis, this company would be one of the largest beneficiaries of a potential repatriation holiday. Now, at the end of the day, with some help from either KYOC and or the U.S. government, I want to bring your attention back to AVX. AVX stock could break out and benefit. So, the fortress balance sheet of KYO provides some downside protection, and technological advancements provide potential growth. You want to be keeping your eye on KYO. Next boring or sleeper stock to get your P.A.I.D. is Crown Holdings, symbol CCK. Now, CCK is one of the most classically boring stocks to actualize or buy to open, and it's also a cheap one. You see, the company's primary business is making aluminum cans for much better known customers like Coca-Cola. That's right. They make the aluminum cans for Coca-Cola. They make the aluminum cans for Anheuser-Busch. They make the aluminum cans for Heineken. And they make the aluminum cans for Pepsi as well. Many investors value those particular stocks that I just listed at 20 times plus earnings. But CCK trades at under 15 times, the midpoint of its 2017 guidance. That's despite the fact that Crown's earnings actually are growing faster than those of the major customers I just mentioned. I'm talking about that Coca-Cola. I'm talking about that Anheuser-Busch. I'm talking about that Heineken and PepsiCo. Competition is stiff, with Ball Corporation leading the market after its merger with Reaxum, and that closed last year. And a spike in aluminum prices could cause more near-term disruption as well. But the valuation disconnect between Crown's business and that of its chief customers is too large. And it seems at least partially because investors simply aren't as familiar with Crown as they are with its famous customers. That creates an opportunity, family members, for us to actualize or buy to open on this 90-year-old business at a nice discount and benefit from what should be years of rising demand. Family members, Crown Holdings, symbol CK. Next position I want to give you is Air Products and Chemicals, symbol APD. That's Air Products and Chemicals, symbol APD. Now, it's hard to imagine a stock more boring than that of a company that makes air. But that's the case at Air Products and Chemicals. Once again, that symbol is APD. This company produces gases such as oxygen, nitrogen, and hydrogen for industrial applications. Now, that said, the APD story has become a bit more interesting as of late. You see, the company has undergone a 5-point transformation over the past few years. Air Products spun off its electronics material business, okay, and is focusing on operational efficiencies in its existing businesses. Those efforts appear to have more potential impact after a Q2 when and where management admittedly worked very, very stringently on productivity. In addition, APD has about $8 billion in excess cash to be invested, whether into the business that it currently has or in shareholder returns. Now, that could lead to an increase in that dividend, which we love, which currently yields 2.6%, or an expanded share repurchase by the company as well. Now, APD stock isn't the cheapest stock to actualize or buy to open right now at more than 23 times guided 2017 EPS. But with plenty of room for organic improvement and exposure to an improving industrial sector, there's room for more upside. And while selling air may not sound sexy, Air Products has built a $30 billion business doing exactly that. And that business should drive more upside in the future. And did you mean we, the ASK the Wiz Wealth Institute family? P.A.I.D. Next position I want to give you is DST Systems, trading under the symbol DST. Now, DST has established a solid niche in the financial services and healthcare industries though you never really see it. And it's as an extensively important, okay, to both of those industries. Very, very important. In financial services, DST Systems does everything from transaction processing to trade reconciliation to investor reporting. And in the healthcare arena, it provides claims and benefit management along with payment processing and even business intelligence. You see, the advantage for DST is that it becomes quite literally embedded in the operations of its customers. That in turn creates high switching costs and high customer loyalty. And according to the company's most recent presentations, its top 5 financial services customers and their relationships have lasted an average of 20 years. The figure is 19 years in the healthcare arena. And as a result, DST has driven steady net income growth. Yet DST stock hasn't gained all that much as of late. In fact, it trades below 2015 levels. Go figure. Now consider this. DST is valued at roughly 18 times 2017 EPS, despite predictions of double-digit earnings growth this year and next year. That's too cheap, and a hiked dividend and a 2-for-1 stock split could boost the stock in the very near term. Now, DST Systems might have a market cap of nearly $4 billion, but too few investors even know that the company does or that the company exists. That's likely why the stock is so undervalued. DST family, to get your P.A.I.D. Next position I want to give you is MetLife. That's right, symbol M-E-T. Now, MetLife isn't without its problems. Disappointing 2017 guidance was driven by concerns overseas, and tax rate changes in Japan and political pressures in Chile both are impacting near-term results. Confusions and concerns about its too big to fail designation similarly has pressured the MET stock price. But this insurance and annuities outfit has been through very, very much in its past, and it's been through much, much worse in its 150-year history. And the mid to long-term outlook still seems reasonably bright for this company. Higher interest rates will help returns on MetLife's float, and the rising stock market should provide a tailwind on the front end as well. Besides, Met, symbol M-E-T, simply looks too cheap at this point. Family, the stock trades at less than 10 times its 2017 EPS estimates and 0.82 times book value. The near-term concerns aren't immaterial, but they look more than priced into the current stock price. One of the world's largest and most successful insurers is available at a discount, and that's that MET. That's exactly what you should be looking for when hunting down boring stocks to actualize or buy the open. Next position I want to give you is First Energy, symbol FE. That's First Energy, symbol FE. Now, utilities are the most classically boring stocks in the entire market. Safe, dependable, and defensive, utility stocks are a favorite of income investors, including yours truly. They're also hardly the types of stocks to provide stimulating conversation or produce notable returns. But steady appreciation, yes, and reliable dividends have reeled in people because of that appeal to investors with a long-term horizon. And even in the utility space, bargains can still be found on occasion. Such appears to be the case at the moment with First Energy Corp, symbol FE, which is admittedly the most exciting thing going on in the utility space right now. First Energy is pressing for Ohio state legislators to fund subsidies for 2 nuclear power plants in the state of Ohio. That effort has been paused for the time being, and news of the pause helped drive FE stock to a 14-year low. But FE stock now yields just under 5%, and it seems no coincidence that the stock bounced quickly after clearing a 5% yield last week. A political loss hardly means the end of First Energy's business, and the stock trades at just 10 times the midpoint of the 2017 earnings guidance after a Q1 beat. Now, as far as utilities go, FE stock probably is riskier than most, but a 10-time multiple and a 5% yield for a business that should create profits for years to come seems to have priced in those risks and then some. FE to get your P.A.I.D. The next position is a way and means of monetizing what is known as blue gold. We're talking about water, and we're talking about American Waterworks, symbol AWK. Now, on the other end of the utility spectrum is American Waterworks Company, symbol AWK. Now, this is the country's largest water utility. That's American Waterworks Company, symbol AWK, is the United States' largest water utility. And American Waterworks has 15 million customers in some 47 states. Now, American Waterworks has managed to grow much more quickly than most utilities, in large part due to its M&A strategy. The company generally seeks out struggling municipal water authorities, offering much needed capital for upgrades and maintenance. That strategy has led AWK stock to nearly quadruple since its April 2008 IPO. In fact, at this point, the only concern might be valuation. Now, the stock trades at more than 25 times the midpoint of the 2017 EPS guidance, a hefty multiple for the utility space, and a premium to second-place peer Aqua America, symbol WTR, another water-related position that has paid us consistently over the past. Still, investors generally have to pay for quality, and further execution on the M&A front and the ever-increasing demand for water across the country both imply additional longer-term upside for our friends here at AWK. Now, utilities might generally be boring, but AWK has proven that even a seemingly boring company can drive impressive growth and get you P.A.I.D. The next position is one of the big boys in the banking arena, talking about the Bank of America, symbol BAC, talking about boring stocks to get your P.A.I.D. Now, in this day and age, you can make the case that there are no more boring bank stocks out there. Certainly the days of the 363 banking offers 3% on deposits, lend at 6%, and be on the golf course by 3 p.m. are all over. That's that 363 banking. Regulatory changes and the combination of consumer and investment banking operations have altered the industry for good. But among banking majors, Bank of America, symbol BAC, still hews closest to the old line banking model. Its Merrill Lynch unit does give exposure to investment banking and more volatile trading profits, but strong results of late have been driven by steady improvements in the core consumer banking business. Charge-offs have indeed declined for Bank of America, and net interest income is benefiting from higher interest rates. Now, B of A is steadily and incrementally improving its operations and its profits. Now, that might sound like a boring strategy, particularly relative to other mega cap financial stocks. But in this case, that's a good thing. Wells Fargo has its ongoing accounting scandal. Goldman Sachs has a major greater exposure to lumpy and sometimes volatile trading and investment banking revenues. And J.P. Morgan Chase is probably the closest to Bank of America's model, but even its non-customer profits are bigger on a relative basis. In its space, Bank of America's business model probably is as close as you can get to boring. So far this year, that business model has led Bank of America stock to outperform its rivals, however, and analysts expect that to continue going forward. You've just received 10 boring sleeper businesses that will get you P.A.I.D. We're talking about Bank of America, symbol BA.